All right, guys. Ooh. Welcome back to another trade recap. Today, we will be doing a recap on ticker symbol INDP and how we were able to catch a 7 point move, risking only a point and a half to catch the breakout above 21. Three things that we did successfully in this trade is one, understand the price action early on and understanding the structure using a Fibonacci and a really common chart pattern. Number two was understanding how these small caps operate and how they tend to move off the momentum. And the last thing is scaling in and the overall execution of the trade and how we use a feeler position to help us gauge the strength behind a stock. So let's take a look at it uh, in the pre-market before looking at the intraday price action. So INDP from yesterday's close roughly around the 7.5 mark before gapping up all the way up to the 12 point mark, uh, nearly a 5 point gain in the pre-market. Now, one thing about small caps is they tend to run pretty hard, but for a very short period of time before short start stepping in and profit taking occurs. So uh, at the open, it did hit my scanner, and I began to watch it sometime around 7:10. So I did miss this move right here, but I was in no rush to get in a position, simply because I know that these uh, small caps can be very tricky. You really need to be observant and be very, very picky about your entries and fight for that dollar cost average. So we did miss this impulse, but uh, one thing we can take away from that opening drive is that it's coming in with a lot of momentum. So quickly off the open, uh, we can see that the 22 mark got rejected twice. So I quickly drew a Fibonacci retracement to see what side had the momentum. As long as we stayed above the 50% mark, there is control by the bulls. If we fall below the 50% retracement, shorts are now in control and people are underwater. That's how I use the Fibonacci retracement, nothing else. Um, so confirmation number one for a dip buy to see if there was another attempt to get above the 22 mark uh, was that it was holding above the 50% mark. So uh, I entered with a feeler position, and if you know anything about feeler positions, is that they help you sort of gauge the strength behind a stock versus watching it. It gives you a totally different perspective uh, about the price action than if you were just watching it because you're in it. You have a bit of skin in the game, so you can kind of see if it's going to work out in your favor. And if it starts moving in your favor, is when you start to add. And when you get further confirmation, is when you add even more. And then, you pick your exit. So, uh, the next thing is the pattern that it was forming while staying above the 50% mark. This pattern right here is simply a flag. And you can see that other traders also knew about this flag because it broke out before momentarily folding over, right? So nonetheless, is buyers bought this bull flag that allowed it to break out momentarily, which further shows us that they're still around and they're interested for maybe a retest at the 22 mark. Now, another observation is that there was two rejections at the 22 mark. If you short sell, this is a common intraday pattern for short sellers, is the intraday double top. So typically after this double top, short sellers will try to step in after it and drive the stock down lower. So having seen this, I would assume that short sellers tried stepping in shortly after these two rejections. So anywhere between here and there is where I would say short sellers were trying to step in before they got squeezed out. And we'll take that out and boom. Okay, so the price action breaks out of the bull flag, clear bull flag, and then we see that there's a little bit of volatility. A little bit of volatility right there. That is the volatility that you want to see near a critical level and for a retest of the previous high of day along with a short squeeze, momentarily short squeeze. Now the reason why is because when there is volatility around the highs, it indicates that there's presence both by the buyers and the sellers. Otherwise, you wouldn't have all that price movement in there. If there wasn't, both sides on this side of the field, price would maybe just come up, hang around, and then fold over really slowly. So we get that volatility, and if we look at the other time frames, we can see on the 15-minute, we get this candle with really long wicks on either side of the body. That is what you want to see before a momentum breakout and a slight short squeeze. So, one, bullish aggression. You're trading above the 50% mark. Price starts to consolidate. You gain the volatility in price. And then lastly, price begins to creep up. So in this order, bullish aggression, a pullback with consolidation, you get the volatility and price beginning to creep up. Now, why do you get this surge in price very drastically? Is simply shorts covering. Shorts covering and then other momentum traders stepping in, adding to their positions, which they built in this zone between the 18 and 22 mark, anticipating that 22 mark. The break of the 22 mark, I'm sorry. So once you do get that breakout, it all just becomes a matter of finding your exit. So let's clear all of this and take a look at where we entered and how we netted $700 using only 100 shares. And I'm going to give you the specifics on the entries. So the first entry that I did want to take, but I didn't get filled, was right here when I saw that price was consolidating. A short's worst nightmare is when price consolidates and begins to creep up near high of day. They do not like it, and I also understand that because I like to short on occasions. So I understand that feeling when price starts kind of creeping up. They know they're going to have to cover. So I got a feeler position of 20 shares at 7:57 a.m. So roughly right there. I added another 25 shortly after. And then once I saw that the volatility came and price was holding and starting to creep up, I added another 35 at 8:35, which was right here. And then added another 28 for a net total of 108 shares at 8:46, and that was at shortly after that breakout. This large candle is most likely due to shorts covering. They were risking towards that 22 or the high of day. And I exited all 108 shares at 28 and a half at 8:46 a.m. So I'm sorry. It was at 28.50 was my exit, and it was at 8:56. So literally at the top. We couldn't have timed that exit any better. But one thing we've learned about small caps is they do not sustain their prices for very long. If you've captured a 7-point move in a matter of, what's that, 20 minutes, you better lock in those profits. Nothing else said. So 3 things for the recap is understanding the market structure, how we utilize the Fibonacci retracement to see who was in control, short or long, in this case the longs. We also use the chart pattern, which confirms that buyers were still around looking for a retest of the high of the day and potentially squeezing out the shorts, which again they did. 2 is understanding how shorts operate, especially if you have a tendency to short. You know when other shorts are in trouble or are begin to exit and cover their positions. And then lastly, 3 was scaling, and especially these initial 2 positions, which gave us sort of a feel for the stock that allowed us to gain the confidence to add at near the high of day, before the breakout, and after the breakout. So 4 different entries for a great dollar cost average and a phenomenal exit at the peak. So results of the trade, $700 in a matter of, what is that, like an hour of trading. Not bad. Taking the profits and running with them. And that is how we keep trading simple. And on to the next one. So if you guys have any questions on small caps, I do trade them occasionally. So you guys go ahead and leave any questions that you guys have down below in the comments, and we'll be back